So hello all, welcome to this Friday webinar on the topic navigating the current investment landscape of macro top-down perspective. To brief for the what is macro top-down perspective is one must understand the macroeconomic landscape. It is very important for the investors to proceed to allocate assets across various sectors and asset classes that they are expected to benefit the most from the prevailing economic conditions. That's the most important part. Though I'm not the expert to explain on this, we have an expert on the table to explain about this. Welcome you, sir.
Thank you so much, Akshara.
Yeah. So let me, before giving the podium to you, I just want to give a very small brief about the speaker. Mr. Amit Goel is the co-founder and chief global strategist of Fiscal Group, leading financial services firm in India, established in 1995. He has over 26 years of experience in managing and advising on proprietary and client investments across all financial asset classes in both developed and emerging markets under the asset management arm of the group Phase 360. Under his lead, Phase 360 has manufactured some of the best performing PMS and AIF funds in the country. As a pioneer in the macro top-down strategy in India, Amit practices a unique investment philosophy accumulating sites from the range of fields including economics, finance, technical analysis, and behavioral science and global politics. Macro top-down approach enables him to arrive at the most viable asset allocations, resulting in unprecedented success in constantly beating the markets over the 2 decades. Amit holds a master's in business administration and finance from Faculty in Management Studies in Delhi. Thank you, sir. Over to you. Before giving the podium to you, let me request the audience or participants to not put stock-specific questions on the Q&A box and not to put the questions in the chat box. Thank you, sir. Over to you.
Thank you so much, Akshara. So a very warm welcome to all our participants from all across the globe. And since we have limited time, so we'll hit the ground running. So here is what macro top-down approach means. So basically, we start absolutely from the top. We start from the GDP data. We look at inflation. We look at bond yields. We look at inflation. We look at bond spreads. We look at corporate profit margins. So we look at the whole host of things, but we start absolutely from the top. And this is basically an amalgamation of multiple streams. So we look at economics, we look at finance, we look at fund flows, we look at sentiment indicators, we look at anthropology, we look at geopolitics, technology. So we look at whole host of these subjects on a real-time basis all over the world, not just India, but literally all over the world. And based on this analysis and based on our understanding of where we are in the global macroeconomic cycle, we then come to the asset classes where we want to be overweight and the asset classes where we want to be underweight for our clients. Then the next step is selecting the right sector. So within the asset class, if there are multiple sectors, we would want to be in the right sectors, and we would want to avoid the unpreferred sectors, so to say. And last but not the least, we come down to the individual stocks and bonds, because that is where we would be investing in. But that is absolutely at the bottom of the pyramid, which is just the opposite of what my peers in the micro bottoms-up strategy would do. So they would start absolutely from the bottom. They would look at the managements, they would look at the companies, and then they would come up. And we do absolutely everything in the reverse order compared to the micro bottoms-up guys. Yeah. So macro top-down. Why macro top-down is the right asset management strategies for investors and for our audience today. So macro top-down, historically, it has been proven that macro top-down has generated higher returns in the long term for their clients. This is one. Second, the volatility of a macro top-down strategy is much less. So the risk and the standard deviation of a macro top-down strategy would be much less compared to a micro bottoms-up strategy. This is because a macro top-down strategy by definition would want to avoid all asset classes which are overvalued. So when the overvalued asset classes come down, macro top-down would be not invested in those asset classes, because of which the volatility is much, much lower. But apart from these two very important facts, there is no doubt that there are a few things which only a macro top-down strategy can do for you. One, this can generate returns for you across bull markets and bear markets. So you know that a micro bottoms-up strategy can generate huge returns in a bull market. But when the bear market comes, there is not going to be even a single micro bottoms-up fund manager or an asset management company which would deliver positive returns. They would all be negative by definition. So macro top-down generates returns across bull and bear markets. Macro top-down is completely uncorrelated with the returns of any single asset class, or for that matter, uncorrelated with all your other investments in the mutual fund, AIF and PMS category, because they would be, to a large extent, their fortunes would be tied to what the equity market does, while macro top-down tries to cherry pick the right asset classes for you. And last but not the least, if the times are volatile, if the markets are sideways, or if they are downward trending, it has been absolutely proven beyond doubt that a macro top-down strategy can and will outperform all micro bottoms-up strategies if the markets are sideways, volatile, or downward trending. And over the long term, this would generate higher returns with much lower risk. So this is the reason why we believe that macro top-down is absolutely the right strategy for our investors and for our audience. So this is who we are. So Pace 360 is, of course, the asset management arm of Pace Group. We are a 28-year-old group. Pace 360 is pioneer and national leaders in macro top-down. So globally, macro top-down is worth trillions and trillions of dollars. In India, it's not so big right now, but there has been huge awareness in the last 5 years. And going forward, I can practically guarantee that you are going to hear a lot more about macro top-down than you've heard in the last 5 to 10 years. So it's growing up at a scale and at a speed which is unmatched to any other style of management today. Then, of course, we have a very strong research team. So we collectively have much more than 100 years of experience in our research asset management division. We cater to more than 100 plus family offices and institutions. But of course, we also do business with ultra HNIs, with HNIs, and even with our IFAs and distributors. We manage more than $2 billion USD of assets in India and globally put together. Pace Group has branches in 350 cities across 350 branches across 75 cities in the country. So that gives us our outreach and our sales muscle. So now coming to the next chapter. So we would now want to share with you where we stand today in terms of economics and in terms of financial markets, where we are today after whatever has happened in the last few years. So this is a very important chart which tells you where we are today, guys. So you know that Fed has tightened a lot, and most of the central banks in the world have tightened a lot in the last 1.5 to 2 years. It is a matter of fact that the yield curves have inverted in most of the developed world. So US, Europe, UK, and most of the countries, the yield curve is flat or inverted today, which is usually considered a harbinger of recession. Then there is this leading economic indicators in US, which has been now negative for all the months in the last 1 year. And that is also considered a very powerful sign of a recession, which is probably on the horizon. But in spite of all these factors, the fact of the matter is that the global growth today is still pretty robust. You can leave aside, of course, a few economies which are really underwhelming at the moment, and China being one of them. But apart from that, the global growth has been rather robust. The unemployment is at a multi-decade low for many of the countries, and the corporate profit margins, though they have come down a little, but they are still pretty robust. So in spite of this negative macro backdrop, the current numbers and the current economic data is still pretty healthy. But having said that, if you look at the consensus of economists, the top economists in US and in other parts of the world, their consensus expectation is still that US is going to go into negative growth rate over the next 1 year. The probability of a recession is considered very high right now. And the inflation is expected to go down over the next 2 years, but over the next few months, inflation may go up because of the recent increase in energy and food prices. So if you look at the consensus economists' expectations for the next 1 year, it's not robust. On one hand, they are expecting a recession, and on the other hand, they expect the inflation to move up over the next few months. So this is a negative macro backdrop for all risk assets. This is consensus expectations. This is not necessarily our best prediction as of now. So this is what various asset classes have done in the last 10 years. It's been an absolutely stunning ride for the risk assets. As you can see, S&P up 166%, Nifty 236, NASDAQ 302, BSE small cap, one of the best performing equity indices in the last 10 years, is up 560%. Of course, Tesla is up some crazy 2,500%. But broadly speaking, the risk assets have done extremely well. Gold has been rather lukewarm. It has delivered 44% over 10 years. But if you look at last 12 years, then gold has essentially done nothing in dollar terms. So gold is exactly where it was. In fact, it is lower than where it was 12 years back. So in 12 years, gold has actually given a negative return in dollar terms. And it's been a bad time to have bonds, particularly in the last 2 years. The returns have been so negative for the bonds that the returns for the last 10 years is now -2%. This is US 30-year bond, which is a very large size fixed income market. So this tells you how bonds have underperformed, gold has underperformed, China has underperformed, but broadly speaking, global risk assets, particularly US equities, have been absolutely stunning. Now, last 15 years, since the GFC, it has basically been US. It has all been about US. So US has delivered 561% for S&P 500 since the great financial crisis. And compared to that, Europe is just up 175%. So this tells you how much US has dominated the whole spectrum of global risk assets and the whole spectrum of global equity indices. So this is where we are. So in spite of the fact that unemployment is so low, in spite of the fact that the economic data is healthy, in spite of the fact that post-COVID, there has been a robust bounce in most economies of the world, but fiscal deficits all over the world are still extremely high. And in US, for example, we are on course to delivering a higher fiscal deficit than even World War II. So this tells you how bad the situation is in terms of fiscal health, which clearly means that if the global economy slows down, the defense mechanism of the world in the form of fiscal and monetary easing is not going to come up this time, because fiscally the policy is already so loose, it cannot probably become much looser than this. And monetarily, the inflation has been such a big scare that central banks would be scared of reducing the interest rates, which means that if there is a slowdown or bleak recession in the next 1 year, we are pretty much defenseless for most economies of the world. So this is what the bond market and the credit markets are telling us, and they usually have the best predicting capability out of all global asset classes. Bond markets are supposed to be the wisest, and bond markets are supposed to be the leading indicator for what's going to happen to the world and what's going to happen in equities and what's going to happen in financial markets. As you can see, that this is particularly about US, but you can imagine that this is pretty much the trend for most parts of the world today. The banks are tightening standards for credit. So you can see that whenever the banks have tightened credit standards as much as they have done right now, US has gone into a recession. It happened after the tech bubble of 2000, it happened in GFC, and it happened in COVID. So this indicator is telling us that there is a recession somewhere lurking around the corner. So this tells you how Eurozone is a lot worse than US when it comes to credit conditions, because in Eurozone, banks do about 77% of the total lending. In US, it's just about 23%, which means that the the standards which are tightening across Europe and across US, this is going to affect Europe a lot worse than US, because US has a great shadow banking. It has got this great part of the lending industry which is beyond the banks. So if banks tighten their standard, US has more flexibility and more dynamism to handle the situation. But Europe has much less chance to handle the situation if the banks continue to tighten their credit standards. So business demand for bank loans in US and EU is plummeting. This is the worst after the great financial crisis. This is again an indicator which tells you that we are probably headed for a recession. You may not see it right now in the data, but it is somewhere lurking around the corner, and you give it about 6 months to 12 months. This indicator and so many other indicators that we are talking about, they are pointing towards a coming slowdown and a recession over the next 1 year in US, in Europe, and in many parts of the world. So again, this is again an indicator which is a leading one. So the default cycle has already started. The default rates are going up in US and in other parts of the world, both in the high grade bonds as well as in the high yield bonds, the speculative bonds. Every recession is represented by a massive rise in the default rates. This is still rather at an inception stage, but the trend is very, very clear. The default rates are going up, and they will go up even more over the next 1 to 2 years. So this is a very, very useful indicator which we have used in the past a lot and which has never failed us. So this indicator tells us that the corporate bond yields in US are now, on an average, they are just 0.12% above the Fed funds rate. So this tells you how banks are lending money to corporates at low rates compared to the US short-term rate. So we are not talking, the rates have of course gone up because the Fed funds rate has gone up by 525 basis points. But the fact of the matter is that there is no spread between the Fed funds rate and the corporate yields. And whenever in the last 24 years, this spread has gone as low as where it is today, it has been followed by a recession. And this indicator is again pointing to a recession in the next 1 year. So these were the indicators from the bond market. Now let's look at leading indicators from across asset classes, across parts of the economy, global economy, and what they are telling us about where we are headed for equities, for fixed income, and the other asset classes. So smart money versus dumb money. So if you look at this indicator, so there are typically what they have done is that particularly in US, they have identified pockets of money which have usually outperformed, which have usually been on the right side of the market, and they have identified pockets of money which have usually been on the wrong side of the market. So those guys who collectively have been on the wrong side of the market, that's called dumb market. Please excuse my use of the word dumb, guys. So if you look at last 1 year, but of course, I can go back to last 20, 30 years and this indicator has not failed you. But if you look at October 22, when the global equities were at their lowest of last 2 years, at that stage, you can see that the smart money was supremely confident and the dumb money was extremely underconfident. And look at what happened after that. There has been a massive rally in the whole world since October of 2022. Now, again, if you see what is happening, dumb money confidence was very high in July and smart money confidence was extremely low in July. Markets have already corrected in the last 3 to 4 weeks. So markets have come down from the highs. Dumb money confidence has come down slightly. Smart money confidence has gone up. So what this indicator tells us is that while in the short term to near term, it is possible that the markets may rebound because they have come down a lot. But in the long term, markets have to come down a lot more for the smart money to become confident and for the dumb money to become pessimistic. So long term, we are probably still headed down, but short term to medium term, it is possible that we rebound or we go sideways. Again, a stunning indicator which has not failed us in the last 110 years. So M2 money supply in US has gone negative year on year only thrice in last 110 years. One, at the end of the First World War, second, at the time of Great Depression, and third, now. Every time it has gone down below zero, it indicates one, a deflation, a period of deflation ahead. So we believe a deflation, period of deflation is ahead of us, and it is quite likely that the inflation rates all over the world are going to come down a lot over the next 1 year. This indicator is telling us that, and this indicator is also a very useful tool in predicting when could the next recession happen. So if you look at what this indicator has told us over the last 100 years, whenever there has been a sharp fall in M2 money supply, not necessarily going into negative, but whenever there has been a sharp fall, there has always been a recession within the next few months or quarters. And this time, not only has there been a sharp fall, but it has also gone into negative. So this is, again, a very sure shot indicator that we are headed for a recession. This indicator is also telling us we are headed for a bout of deflation. So looks like it is going to be a deflationary recession over the next 2 to 3 years. Again, a great contrarian indicator. So what this indicator does is that it does they do a survey of investors across the spectrum, and they try to gauge what the sentiment is. And what we have seen is that when the sentiment is at its lowest ebb, the markets always rebound after that. The sentiment, as you can see, was extremely low at the time of great financial crisis, minus 51%. And that was the best time in the last 20 years to go long on equities, guys. Similarly, last year, when in October, the markets were extremely low, there was a huge fall. This sentiment indicator was at minus 43%. And last year, September, October was the best time to buy equities in the last 2 years. Now this indicator is above this cutoff line, which we called, which is sort of an indicator of greed. So every time this has gone above this greed line, like it has this time, this is an indicator that the markets are going to turn south. This indicator has practically never failed us in the last about 35 years. And the professional money managers who have got this long track record of selling at the bottoms and buying at the tops. Now, these people, if you look at what they have done in the last, let's say, 15 years around GFC and beyond, you can see that when these people are underconfident, as indicated by the red lines, then markets are close to the interim bottoms. Like they were in 2022, you can see that these professional managers were bearish, they were pessimistic, and they were selling. And now those same people who were selling around October of 2022, they have turned big buyers over the last 2 months. So this indicator is again telling us that the markets have come up a lot, and probably there is more downside in the markets, and the next big move in the markets is going to be on the way down and not on the way up. So US small businesses. So we've covered some indicators on the markets, but this is a very useful indicator when it comes to predicting what's going to happen in the economy. And US is, of course, the mother economy of the world, and we can see that only 5% of small businesses, and these small businesses account for bulk of the employment generation in US, only 5% of them think it's a good time to expand. So this indicator, the only time it has been as bad as it is right now was during the GFC. Every time this indicator has come down sharply, it has been followed by a recession. So this indicator is again telling us that US is headed for a recession, and the employment situation, which is the employment market, which is extremely tight right now, is probably going to take a turn for the worse over the next 1 to 2 years. So these are US leading economic indicators, which are a combination of a host of indicators on US economy. And what we see is that every time the leading economic indicators come down, and you can see this chart is for the last 64 years, every time it comes down, there is a very high chance that there is going to be a recession. So this is exactly what is going on right now. The leading economic indicators have come down a lot, and they seem to be coming down even more. And the other chart is telling us that the leading versus lagging ratio is now not only it has come down a lot, but it is at one of the lowest of last 65 years. So which means that not only is a recession probably on the horizon, but it also means that this could be a deep recession. So the indicator, the leading versus lagging. So what it tells us is that the leading indicators are very bearish, but lagging indicators, which include consumer spending, which include employment, and which include corporate profits, these are lagging indicators. They are holding up, but the leading indicators are screaming recession. They are screaming a bear market right now. So this is again a very, very useful indicator that has stood the test of time. Now, this is a long-term chart. This covers last 233 years of US economy. 230 years back, when the trend growth rate of US was about 4 to 4.5%, and the debt levels were extremely down, this red line indicates that the trend growth over a period of time has come down from 4.5% to about 2 to 2.5%. In fact, it's about 2% right now. So this indicator, this is telling us that the trend growth rate has come down. Even the population growth rate is now not what it used to be, and the debt levels are at sky high levels. So the debt levels as a percentage of US GDP in US, this is about 460 to 470%. This is an all-time high. And whenever there is such a sharp increase in debt levels versus GDP, you can see that a sharp recession and a sharp correction and a sharp reversal follows. In Great Depression, just before the Great Depression, there was a huge rise in debt levels. And we look at what happened after that. The markets collapsed, the economy collapsed, and the debt levels came down. Similarly, at the time of GFC, this had gone up a lot. The economy came down, the markets came down, and the debt levels came down. This indicator is telling us that there is a very high probability that the debt levels will come down, but the debt levels will come down only when the economy shrinks. Last time such a big reversion happened was at the time of Great Depression. I'm not saying that we are necessarily headed for something like a depression, but this is definitely a harbinger of a recession, and that too a pretty deep one. So, again, this time when the interest rates have gone up, there is talk of soft landing everywhere. If you look at what the economists are saying or what the asset managers are saying, they are mostly talking about soft landing. But guys, look at this chart. Last 33 years, whenever the Fed funds rate were at their peak, economists and asset managers were talking about soft landing. But every time this soft landing story became a hard landing story within the next 1 to 2 years. So this time, what has happened is not for the first time. This has repeatedly been the trend in the last 33 years, and this is probably going to happen this time as well. This soft landing verdict of the market and economists is going to change to hard landing verdict, and we probably would bet on that happening. So I would just cover this as shortly as possible. So the US rents have already they've already started coming down. The US CPI has come down, but if you exclude something called owner's equivalent rent from the inflation numbers, then we are already at about 2.3% core inflation rate in US, which is almost in the Fed's comfort zone. But this indicator is telling us that within the next 1 year, as the rentals come down and as the owner's equivalent rent comes down, this indicator is suggesting that the US inflation rate is going to come down to 1% in the next 6 to 10 months. That is going to be a huge plus for the bonds, but unfortunately, it may not be a huge plus for the equities, because this could come down with the rest of the economic indicators, which means that you could get a deflationary recession. This is what this indicator is also supporting. So after these leading economic indicators, we would want to cover a bit of China, because China is actually the big elephant, and it has a big impact on global economy and the global financial markets. Chinese economy is right now on a one-way street to economic calamity, it seems. This is like a sinking ship. The debt levels are so high. The GDP growth rate is slowing down. Consumer spending slowing down. Investments, fixed capital formation slowing down. Real estate in a complete mess. And real estate contributes about 25% of the Chinese economy. So not only is their debt burden very high, but unfortunately for them, China has got the worst quality debt problem in the world, the worst quality debt, because most of this debt has gone into provincial governments and to other parts of the economy where the return on that capital is close to zero. So if the debt level is high, but the productivity is very high and the profit margins are high, then you can sustain high debt levels. But unfortunately for China, not only is the debt level unsustainable, but it is also a very, very bad quality debt. Lot of NPAs are happening. Banking is in a complete mess. So this is probably the biggest reason why Chinese economy is going to go down over the next few years. So unlike the rest of the world where inflation is the buzzword, in China, it's all about deflation and disinflation. As you can see, the CPI number is close to zero. PPI number is in the negative. So China has a deflation problem, but that's not a good problem to have, because it is because of the lack of demand. So it might sound enviable for economies which today have a 5% inflation rate, but in China, this is because of low demand, and this is again suggestive of the fact that Chinese economy is going to go hurtling down. Urban unemployment rate, in any other part of the world, if this would happen, this would call for a social unrest. Probably it may not necessarily happen in China, but there is a lot of unrest and discontent within. And this indicator is also suggestive of the fact that their economy and their employment market is now in a bad shape. It's going to go down. It's probably going to go worse before it gets better, and probably a lot worse. And if you look at the Chinese corporate sector, huge defaults are happening. Look at their real estate sector. Country Garden just defaulted. Evergrande has today declared bankruptcy. So huge amount of defaults from all over China. And I personally believe that in the last 30 to 40 years, I haven't seen an economy which is in a worse shape than what China is in today. A lot of their shadow banking industry is in crisis mode. A lot of defaults happening there as well. China today looks to me worse than what Japan looked to me in 1989. So that is how bad China is looking. They have defied gravity for a very long time, but probably not for too much longer. So now, of course, we come to India. India is now the blue-eyed boy of global investors. Not something which is happening for the first time. In 2007-8, just before the GFC, we were again the blue-eyed boy, and we are a blue-eyed boy again. And the whole world is so positive on India. Indian investors are extremely positive on India. We are not necessarily bearish on India, but we would want to highlight to you certain factors and certain indicators which probably you have not been exposed to at all. So this is a brilliant indicator. What this tells us is that the GDP growth rate has got very little to do with stock market returns. I know this is counterintuitive. Sentiment, the intuitive wisdom would tell us that if the GDP is growing, that the stock markets would do extremely well. Look at what China has done. In the last 35 years, Chinese GDP has gone up by 44 times. And Chinese MSCI China index has actually, if you look at the chart on the other side, Chinese stock market, MSCI China, has delivered a minus 39% in the time when its economy has gone up by 44 times. So all those people who tell you that Indian GDP is going to go up, I completely agree with them. But if they tell you there is a simplistic linear equation between GDP and stock market returns, you can show this chart to them. And this is not just about different countries. Even within, what you can see is that for the same country, there can be a huge variation. In the time when your GDP was going up, your market may be doing nothing. And in times when your GDP has not gone up so much, your market may skyrocket. In case of India, between 92 and 99, our GDP growth rate was substantial. It was very healthy. But our stock markets did not go up at all for those 7 years. Similarly, if you look at India's graph, 50% of the entire absolute return that the Indian markets have generated, it has come in the last 3 years post-COVID. But if you look at it post-COVID, our GDP in dollar terms has just gone up by about 13%. But 50% of the entire return of 35 years has actually happened in last 3 years. So this again tells you that there is no linear equation, no linear relationship between GDP of a country and the stock market returns of the country. If you look at Brazil versus Taiwan, in both the cases, the GDP went up by 6 times. But look, Brazil is up 1,458% in dollar terms, while your Taiwan is just up 529%, right? So Brazil has done 2.8 times better than what Taiwan has done, even though the GDP, the number of times their GDP went up was almost the same. So this indicator is telling us there is no linear relationship between GDP growth rate and the stock market. This is a statement of fact. This is not a matter of opinion. Anybody who tells you otherwise, you can probably share this chart with them. Again, in the Indian context, if you see what happened between 2008 and 2018, our nominal GDP went up from 53 lakh crores to 189 lakh crores, which means our GDP went up by more than 3.5 times, right? But in those 10 years, would you be surprised if I tell you that the Indian corporate sector EPS did not grow at all? So if you look at the Nifty 50, or if you look at NSE 500, you look at their 2008 EPS and you look at the 2018 EPS, it was more or less, it was almost at the same level, in spite of the fact that your nominal GDP went up 3.5 times. So all those people who tell you that today's India's GDP is $3.6 trillion, it's going to become $5 trillion, and the corporate bottom lines are going to go up by 50% or 60%, you can share this chart with them that in those 10 years, for 3.5 times of nominal GDP, our EPS did not budge at all. So if you look at the current P ratio and the forward P ratio for India, we are literally the most expensive market in the world. We are even more expensive than US S&P 500. Of course, we are less expensive than NASDAQ 100. But if you look at a broad-based index, if you look at all broad-based indices, Indian market is literally the most expensive major market of the world. And the chart below shows you what kind of discounts other countries are trading at. So Brazil is at 58% discount, Germany at 42%, MSCI emerging market 49%, China 45%, South Korea 39%. These are big discounts. So even if I agree that yes, Indian growth rate is going to be great, it does not necessarily mean that the Indian stock market is going to do equally well, because we are very expensive and our stock market does not necessarily go up with GDP. Our corporate bottom lines do not necessarily go up with the rise of our nominal GDP. We have just seen that. So now we share the findings and conclusions based on the entire analysis that we've shared with you. And plus, of course, for us, this is an ongoing thing that we've been doing for the last 28 years. So how deep and long-term could be your loss? In 1929, if somebody had invested in the best quality stocks in the world, the US stock market, the best quality stocks, it took them 25 years to get their dollar whole on a real basis. 25 years. In 1968, it took about 24 years. Post the tech bull run, it took about 15 years. And post the GFC, it took about 6 years. So what does this tell you? This tells you that, when your micro bottoms-up asset management companies, when they come to you and they tell you there is a linear relationship between GDP and corporate bottom line, linear relationship between GDP and stock market performance, we have now shown that history does not support that. And similarly, when they tell you that equity markets are always to be invested in and you can just bet on them and wait for the long term, bear in mind that sometimes that long term could be 24 years. This is what happened in US. It could happen to any part of the world. It could theoretically happen to India. I'm not necessarily saying that it would, but it could theoretically happen. Between 92 and 99, for 7 years, we did not recover. Our equity markets did not cross the previous level. That was on an absolute basis. If I talk about real basis, then it took us almost 12 years to come out of it convincingly. That's the kind of time India has sometimes taken to give 1% of real return to the stock market investors. So please be cautious. There is just too much of optimism. We need to check for ourselves and we need to decide for ourselves whether it is justified or whether there could be a slip between the expectations and reality over the next 1 to 2 years. So this tells us about gold. Gold in the long term has never lost its value. So this tells us that between 1971 and 2022, in 50 years, US dollar has lost 98.2% of its value against gold. Euro has lost 98.3%. Swiss franc has lost more than 92%, and Japanese yen has lost 95%. Now, these are the biggest currencies of the world. I'm not even talking about emerging currencies, which could have lost 99.9% of their value. But even the best of currencies have lost about 95, 96% of their value against gold in the last 50 years. And I would bet on it that this trend is going to continue in the coming decades as well. All currencies are going to lose their value in terms of gold, which means that gold is going to go up in the long term against each and every one of the major currencies and also the emerging currencies. So gold price, if you compare it with S&P 500, is literally at the rock bottom of last 100 years. And every time we've gone down so low, there has been a massive rally in gold. And I can bet that this is going to happen this time as well. If you look at the chart on the right-hand side, you would see that gold to S&P 500, whenever the US yield curve inverts, gold to S&P 500 ratio goes up. It has already come up so far in this yield inversion time that has last 15 months. And if this is an indication, if we look at the past, then there is going to be a minimum rise of 72%. Right now, that rise is about 15%. This ratio is going to go up by another 55% at the very minimum based on history. And if we look at the 1973-74 particular case, then this ratio is going to go up by another 120%. So now this ratio can go up in one of the two cases: either gold goes up or S&P 500 goes down, or both happen concomitantly. And I would bet on both. I would bet on gold going up. I would bet on S&P 500 going down. And I would bet that the history is going to repeat itself and gold to S&P 500 ratio is headed higher yet again. So S&P 500 earnings, we've drawn this chart over the last 70 years, and you can see that there is this beautiful uptrending line. We've hit a wall. And even if the good times last, probably earnings per share for US companies is not going to go up, which means the upside is very limited. On the other hand, if a recession happens, like it has in the every time in the last 35 years that has happened, this red line, this diluted EPS and EPS line is going to break the downward channel, and we are actually going to be in negative. So this is what has happened in the last 60, 70 years, and it's probably going to happen this time around as well. So commercial mortgage market, a lot of people come to us and they want to find out if the commercial mortgage market in US and UK and in parts of Europe is going to take down the whole global banking system. What this analysis tells us is that if you look at US, then the size of the commercial mortgage office space, that is the only a part of the commercial mortgage which is in trouble. Hotel is not in trouble. Industrial, retail, healthcare, warehousing, they are not in trouble. It's basically the office space which is in trouble because, of course, the work from home and everything that's been going on. So this $1.2 trillion market is probably not big enough. And it's not that the entire market is going to go down the tube. So even if there is a loss of, let's say, $100 billion, we do not think that it would take the global banking system down with it. This is unlike what happened in 2008-9 when the US housing sector and the US housing mortgage sector took down the world with it. This time it's not going to happen. But at the same time, if this happens when your default on auto loans goes up, your credit card defaults go up, your industrial defaults go up, if this were to happen concomitantly, then of course it does mean that the global banking system is going to be threatened. But commercial mortgage on a standalone basis is probably not going to do that. So now these are the final conclusions. So as we have suggested during the presentation, we are probably headed for a deflationary recession. We believe there is a protracted bear market ahead across risk assets over the next 3 to 5 years. We believe that most of the equity markets could go down by anything from 30% to 50, 60%. And we believe that China is headed for an economic Armageddon. And this is going to be, this is probably going to be the biggest economic development for the next, over the next 5 to 10 years. The downfall of China, the economic downfall of China looks inevitable at this point. And this is going to be the biggest story which is going to occupy our attention. And it's going to have a major, major impact on all asset classes, all geographies, and of course, the global economy broadly. Indian economic story is strong. Do not get me wrong. I'm not a doomsayer on India. I'm not saying India is going to go into a recession. But every time in the last 30 years that the world has gone into a recession, India has gone into a bear market. And we have never gone down less than 30% in any bear market. So even if India's GDP held in 2001 to 3 and 2008 to 9, fact of the matter is that the Indian stock market lost 50% in 2001 to 3 and it lost 60% in GFC. We believe that the world is going to go into a recession. India will probably not go into a recession, but for a few years, we could go into a bear market like we did on some of the previous occasions. And considering the optimism and the buzz around India, I think that's likely to happen. So we are not bearish on the Indian economy. But if the whole world goes down, which looks like it is probably our base case scenario at this point, then the Indian markets are going to go into a bear market. like all previous times. Gold, Japanese yen, long-term US and German government bonds are going to do extremely well over the next 2 to 3 years. I think that is almost cast in stone for us. And tactically, the risk assets may remain sideways. So let's bear in mind that the risk assets have come down a lot in the last 3 weeks. So whether it is US markets or European or India or China, all these markets have come down. So I think tactically we may go into a sideways zone. We may in fact even bounce back from some interim bottoms, but on a long-term basis, the path is clearly down. So on a long-term basis, the path of least resistance is down for the economy, for the global equities, for all global risk assets, including industrial commodities, high yield corporate bonds. They are all looking south. But if you specifically talk to me about the timing and the next few months, I would not be so negative because we've come down a lot and we may become sideways for some time. Now I come to the last chapter of our presentation. So page 360 has got the broadest bouquet of products in India. We literally cater to an entire spectrum of risk tolerance. We've got products which we call secure, for example, which is basically caters to investors, the most risk-averse investors who do not invest beyond bank FDs. So we have products designed for investors who do not go beyond bank FDs, and we've got products on the other side of the spectrum which are meant for people who can tolerate a higher amount of risk, in the hope of getting a higher return. So we cater to the entire spectrum. We cater to clients all over the world. You could give us money in India, you could give us money globally anywhere, and we can manage that money for you because macro top-down, it covers the whole world, it covers the whole country. So we could literally manage money across risk spectrums, across currencies, across geographies, and of course, we do invest across asset classes. So this is what we want to tell you about our range of products. And I just want to showcase one particular product, which happens to be our flagship. It's called Trésor Privé. And this has delivered since inception a return of 19.2%, vis-a-vis the benchmark, which is up only 11.4%. So the alpha is almost 780 basis points CAGR. The risk and standard deviation of this scheme is extremely low, like all our other PMS strategies, and our Sharpe ratio is extremely high. So this is one of our flagship schemes, but across all our schemes, we have beaten the benchmark handsomely every single year since inception. So we now come to the end of the presentation. We would now welcome your questions. Thank you so much for your time and your attention. And we would want you to put to us whatever questions that come to your mind. Thank you.
Thank you, sir. That was a standstill moment for us. We couldn't take eyes off the PPT. You made us, it was very insightful, I must say that. So, of course, then I've got quite less time to jump into the questions, but let's not waste much of time. Let me take this first question from the audience, which is pouring. Just a minute, I'll just take his name. He's Mahendra. He said, good evening, a great analysis. Which sector can you bet in India for next 2 to 3 years? Which asset mix you suggest to lower global effect on overall portfolio?
Okay, so as mentioned, we do believe that fixed income, high quality fixed income is going to do extremely well. We do believe that your long-term government bonds are going to do extremely well, whether it is US or India or UK or Europe. I would tend to gravitate towards US long-term treasuries as probably one of the best asset classes right now. So we are extremely bullish there. We are extremely bullish on gold, extremely bullish on Japanese yen. When it comes to equities, my sweet spot right now is gold miners. If you look at the gold mining companies all over the world, and the good news is that even the Indian investors can invest in gold mining, because there are ETFs in India which basically which are feeder funds to the global gold mining funds, I'm supremely bullish there because I believe that gold is going to go up a lot over the next 3 years. And because of the high operating leverage in gold mining companies, if the gold price goes up by 15%, you can bet that these companies are going to go up by about 50%. And I would bet on 100% capital appreciation in gold mining stocks over the next 2 to 3 years. So we are extremely bullish on these asset classes.
Thank you, sir. I think Ms. Mahendra, your question is answered. So moving on to the next question that I have was that AI has a big role. AI, artificial intelligence, has a big role in this market rally. So where do you think the AI bubble in this market, and what are the repercussions that you see?
Yes, so I agree with the terminology AI bubble. I think there is literally a frenzy around AI. Just like in 99, 2000, there was a frenzy around these startups and these dot-coms. I think there is a frenzy around AI. And I believe that equity markets, particularly US technology companies, are extremely overpriced. Their price to earning multiples are extremely high. Their earnings are actually not growing so much, but their price earning multiples have skyrocketed over the last 6 months. So I think just like the startups and the dot-coms brought down the whole world with them in 2000 to 2003, I believe that the AI frenzy is going to contribute to a global bear market in equities over the next 2 to 3 years. This time, unlike in 99, 2000, the bubble is not just in AI. There is a bubble. There was this SPAC bubble. There is this bubble in private equity. There is this crypto bubble. There is this blockchain bubble. There is this real estate bubble in so many parts of the world. So I see so many bubbles coming together at the same time. In capitalistic history, it has never happened in last, 500, 700 years that we've studied, that so many bubbles have literally happened at the same time. I think we are in uncharted territory when it comes to bubble, and the aftermath of the bubble is going to be visible to us over the next 3 years. So I repeat, we are going to be in a deflationary recession. We are going to be in an equities bear market, and it looks to be a dire outcome for global equities and global risk assets because of not just one bubble, but this multitude of bubbles that have happened literally at the same time.
Yeah, but when you say that we are going to be into a recession or recession time, we are heading towards a recession time. So just wanted to know, like, what are the safeguards that an investor can take at this moment?
Brilliant. So, Akshara, I think the safeguard that one should take is, one, you should reduce your allocation to risk assets. One. Secondly, you should increase your allocation to long-term government bonds. You should increase your allocation to precious metals, particularly gold. And last but not the least, I would say this is a great time to shift money from micro bottoms-up strategies into macro top-down strategies. While it may sound like self-serving, but this is what has happened in history. Every time you believe that markets are close to their tops or there is not much upside in the markets, every time you believe that the valuations are rich, if you have simply moved away from micro bottoms up into macro top down, you are not only going to safeguard your portfolio, but practically history has indicated that the macro top down, even in the worst of bearish times, would continue to give you an inflation plus 5 to inflation plus 7% kind of return, which I think there is absolutely not even a remote scenario that your micro bottoms up can generate over the next 3 years, given the circumstances which we've just spoken about.
Okay. So let's move on. Thank you for the answer. And let's move to the next question from Air Money. Yes. Yes, like how to invest in in gold or gold for this period. If it's physical or ETF or mining stocks or sovereign gold bond.
Fantastic. So see, my best bet right now is gold mining companies. I think the upside that can happen in gold mining companies over the next 1 to 2 years is simply gonna, it's simply gonna outshine the upside on physical gold or demat gold. But having said that, I think for an Indian investor, sovereign gold bond is a great option, because not only is there no management fee, you get a 2.5% interest, and taxation wise it is brilliant because there is no long-term taxation, there is no capital gains taxation if you return it back to the government at the end of the maturity period. On the other hand, if you buy ETFs today, then that is going to be taxed on a short-term basis as short-term capital gains, even if you hold it for 10 years. So my preferences are gold miner stocks, secondly, sovereign gold bond, and then I would say your gold ETFs. So for my overseas investors, the first choice is gold mining companies. SGB is not an option for them. So obviously the next best option is gold ETFs for them.
Okay. Thank you for that, sir. And the next question, when you talk about those macros, we had a lot of uncertainties in the macros. Like for example, we saw COVID, we saw Ukraine-Russia war, we saw GFC and all. So how did phase 360 perform in previous economic downturns and bear markets?
Thank you so much, Akshara. So I would say that we were extremely happy with our performance in 2001 to 3 and again in 2007 to 9. So we were actually, even in 2008, when the Indian equities went down by 60% and US equities went down by about the same, we actually clocked a positive return of about 18 to 20% that year. So typically, and this is not just true for us, this would be true for any good macro top-down asset management company. They would be able to protect your portfolio during crisis times, during recession times, during bear market times, and they would actually end up giving you an inflation plus 5% or maybe even higher return even during the worst of times. So I would not like to take the entire credit to myself or my research team. I would say that macro top-down is what this is about. And I think, again, when the markets go down over the next 2 to 3 years, I'm pretty sure that we would be able to deliver an inflation plus 5% CAGR, and our alpha is going to be in double-digit CAGR for the next 3 years. So I think history is going to get repeated this time around as well.
Okay, one continuation question for that. Like, can you elaborate on the approach of alpha returns in the portfolio, sir?
Sorry, can you say that again?
Generating alpha returns. So could you just elaborate on the approach that you incorporate?
Yeah. So basically what we do is, every time we look at the asset classes, there are some secular asset classes where we believe there is a secular bull run happening. For example, we believe that about gold. So we have the gold part of our portfolio, we have bought for the long term. We are not going to sell it in between till the time we are convinced that gold has attained the highs that it has to achieve. Similarly, long-term government bonds is something which we are very bullish on. And again, that's a long-term investment. As far as equities is concerned, we believe that we are going to be in a bear market over the next 3 years. So our approach for equities is going to be more like guerrilla warfare. So rather than fighting a continuous war, we would do a guerrilla war every time there is blood on the street, every time the markets are down. For example, in the month of March 2023, Indian Nifty was at 16,900. And NASDAQ was at 11,700, NASDAQ 100. And we were supremely confident that the markets are headed up in the near term, not necessarily in the long term, but in the near term. So we completely went crazy buying equities in the month of March. So for equities, till the time we believe that we have hit a bear market bottom, which is probably 2 to 3 years down the line, we will continue to do this guerrilla war. We will continue to do this hit and run, buy equities when they are oversold, buy when they are extremely cheap, and sell them when there is again euphoria or when they have come up. So this is what we will continue to do for all asset classes where we are not long-term bullish, like equities, but for asset classes where we are long-term bullish, like gold, like long-term government bonds, we'll just continue to hold them till the time we believe they have achieved their target. So this is how we generate alpha year after year, how we generate alpha across bull and bear markets. In bull markets, we would have a bias in favor of equities and bias against the other asset classes. In bear markets, we would have a bias in favor of fixed income and precious metals and a bias against equities. But we would continue to make money in equities every time they present us with a great short-term opportunity. Thank you so much.
Thank you. So that was a very elaborate answer. I will say that. With that, let's move to the next question. Just a hypothetical question. Just imagining that I'm a long-term investor with a healthy risk appetite. Do you think the traditional bottom-up stock approach or equity portfolio would suit the person?
Yeah. So see, what I have to say to that is that bottoms up has worked well. So please don't get me wrong. I'm not saying that the bottoms up fund managers have not made money. All that I'm saying is that the next 3 years do not belong to them. The next 3 years are we need to conserve our portfolios, we need to conserve our purchasing power, and we need to tone down our expectations from a 25% return or 20% return to an inflation plus 5%. But that inflation plus 5% is not going to come from micro bottoms up. So the rule of the game is that when a lot of wealth has been generated, like it has been over the last 15 years since the GFC, the rule of the game is that when a lot of wealth has been generated, you just shift from micro bottoms up to macro top down. This has not gone wrong globally any time in the last 100 years. And while, as I mentioned before, it's worth, macro top-down industry is worth trillions of dollars in US and Western world. In India, it's not so big, but it is going to become big. We are making sure that there is more awareness of macro top-down. And we are very, very sure that a lot of people, a lot of investors are going to gain so much. Can you just imagine if we are in a long-term bull run, let's say that over the next 20 years, all of us expect India to do well, right? So if India is to do well, my question to you is, would you rather start with 200 rupees or would you rather start with 50 rupees? So anybody who sticks to equity assets now is probably going to lose 30 to 40% over the next 3 years. So your 100 rupees is probably going to become 60. And by the time the real time comes in, for you to play the great India story, you would have already lost 40% of your money and maybe some part of your conviction. On the other hand, the macro top-down strategy would deliver to you probably over the next 3 years, something like a 40% return. So instead of starting from 60, you would start the great India bull run at 140, guys. So that's the kind of difference we could make over the next 3 years in particular, but then going forward in general, because after 3 years, once we believe that we've hit the bear market bottom, we are going to become micro bottoms up ourselves in some way for the next many years to come. So this is how we believe we are going to generate and create value for our investors, not just in this bear market, but looking much, much beyond the bear market.
Okay. With saying that, what percentage of portfolio should be allocated to the macro top-down approach strategy?
Well, I would say that the juncture that we are at right now, this could be even 100%. Because so much of wealth has been generated. There is so much of risk in micro bottoms up strategies right now. There is nearly a 99% chance that you will get not even inflation returns, you will get probably negative returns over the next 3 years. On the other hand, macro top-down secures your portfolio. It does not go down in the bear market. It is sector agnostic. It will continue to make money in the other asset classes. So I would say that at this stage, practically all your money should be in macro top-down. But of course, after 3 years, I would probably suggest that now the bear market has ended, let's say in 2026. And I would myself recommend to our investors that this is a good time for you to put a lot of your money back to work in micro bottoms up. And we ourselves are probably going to become like a micro bottoms up strategy after 3 years.
Okay. So who are your peers in the macro top-down approach in India and in overseas?
So I would prefer not to take names as such in India, but globally, of course, the biggest names like George Soros, Stanley Druckenmiller, Jeffrey Gundlach, these are some Ray Dalio, these are some big names in the macro top-down world. In India, there are some entities who are doing macro top-down, but I would say that we've got an advantage at the cost of sounding immodest, I would say, because we started 28 years back when macro top-down was not exactly a buzzword. People hardly knew what macro top-down is. Because we started 28 years back, we probably have an edge there, and we continue to be pioneers and national leaders for macro top-down.
Okay, so moving on to the next question from the audience is that Mr. Veeramani Rajashekharan. Since the US is raising interest rates and S&P yields are high, a lower China growth may cause concern about the impact of risk assets sideways in India. What should one do in such a downturn?
Yeah, so, as mentioned before, a downturn is probably a very likely scenario over the next 3 years. As I mentioned before, because of the fact that so many bubbles have literally popped at the same time, we believe this downturn is going to be more severe than your usual downturns. It's going to be a protracted downturn. It's going to be a protracted bear market. So we would continue to believe that your precious metals, your long duration, safe, very, very high quality bonds like government bonds is going to, they are going to stand you in good stead. Gold miners are going to make money for you. And plus, of course, equities, every time they become oversold, we would invest in equities. I can assure you, in the worst of the bear markets, you probably get stunning opportunities to buy equities. It's just that you need to be parked in fixed income, and you need to take that decision when there is blood on the street. In 2008, I can assure you there were at least 4 big waves when we were able to buy and then we were able to sell, which is why we clocked a return of about 18 to 20% in the year 2008, the year of the Lehman crisis. So I think that essentially has to be our approach. This is not the best of times to do micro bottoms up. The micro bottoms up guys, because of their bias towards equities, they would never come to you and tell you that we are headed for a bear market. They didn't do that in 2007-8. They didn't do that in 2015-16 when we had a bear market in India. And they didn't do that in at the time of tech bubble. So I think it's time to take your money out of equities. It's time to take your money out of micro bottoms up strategies and put your money into safe asset classes and put your money into macro top down.
Okay, with saying that, because the whole topic was about the macro top-down approach. So what is the correlation between the bottom-up approach, equity, and a macro top-down approach in current scenario?
It's going to be in many ways negative, because the way I see it, micro bottoms is going to be in negative returns over the next 3 years, while macro top-down is going to generate very healthy returns over the next 3 years, I believe. So in my opinion, it's going to be negative. Of course, last couple of years, it's not been negative because micro bottoms up players also generated a positive return. But of course, macro top down like Pace 360 were able to generate a considerable alpha over the micro bottoms up, even over the last 2 years of the bull market. But I think in the next 3 years, it's going to be negative correlation, because micro bottoms up is going to go negative and macro top down is going to go positive like it has been. So which is why the correlation is probably going to be negative.
Okay. So next question is from Nimesh. He want to ask, do you think already bear market completed, which since started in October 21, has bear market won't last for more than 18 months?
Sorry, which bear market is he talking about, Akshara?
I think 2020-21 bear market is what he's talking about.
Okay, because see, in 2021, actually, all the world markets were in a euphoric stage. So whether it was Nasdaq, it made its top in 2021. Those levels have not come back after that. S&P made its top in January 22. Indian market went up to 18,600 in October of 2021. And today we are at, of course, at let's say 19,300, 400. So we have come up since then. Many of the world markets are considerably down since their peak in 2021. In the real sense, the bear market has not yet started. That's my fundamental point. What you saw was a sideways period for 2 years, and what you are now going to see is a secular bear market for the next 3 years. So this bear market has not started. It's going to start probably over the next few months, but it's going to go a long way down, and it's probably going to take about 3 years. It's not going to be a blink and you miss it kind of bear market like it happened in COVID. This is going to be a protracted period of underperformance and negative returns for global risk assets, including equities, of course.
Okay, sir, thank you. Because we have already 15 minutes past the webinar session, but still, let me conclude with the one final questions. Could you just briefly outline the portfolio diversification strategy for the CAT3 PACE 360 Global Multi-Asset Opportunity Fund, sir?
Thank you, Akshara. So in terms of our CAT3 AIF, what we are doing is that we are on one hand building up a secular position. We have built up a secular position in gold miners, government bonds, and on sovereign gold bonds. But apart from that, we are doing this long short in equities. So we are, when we believe that markets are directionless, we would be almost as much long as we are short. But when we believe that the markets are headed downwards, like we thought in July, we built up a sizable net short position in the month of July. And now we are in the process of going back to neutral stance because we believe that markets are going to be sideways. And in March, we were very, very clear that markets are going to go up. So we were net long in March. We remained net long for a couple of months. In July, we went net short. We are now going back to neutral, not net short, not net long, but that is for the short term. In the near term, whenever we get an opportunity again where we believe that the secular downtrend is again going to start, then we are going to be more short than long. Over the next 3 years, our bias is going to be towards being net short. But of course, having said that, we always try and time the market, and we always try and do that when we believe there is a lot of euphoria around us, rather than doing when there is panic around us. So there was panic in March, so we were net long in our AIF. There was euphoria in July and early August, so that is why we went net short. This is how we manage our risk. And our returns have, of course, been extremely good in AIF. And we believe that over the long term, we'll deliver about 20 to 21% CAGR in our AIF post all expenses.
Yeah, thank you, sir. Thank you. Because I've got a lot of questions pouring in the podium. If I don't take one, I think it's bad in my part. So let me take the last question from the for the podium. Veeramani Rajashekharan, can we expect more FII money in India in comparison to other Asian markets? Where would you see the money we invested if not here?
Right. So my experience in the historical trends that we have seen, they suggest that yes, India would continue to be overweight on the FII radar. India is probably going to get more of FII inflows maybe over the next couple of months. But our experience from the previous global bear markets, I'm not talking about Indian bear market, our experience from the previous global bear markets is that FIIs eventually turn sellers on India. You know that there was a huge amount of FII selling in 2022. Indian market took it on its chin when it came to FII selling. there were literally tens of billions of dollars that were taken out from India. And we believe that when the global trend genuinely becomes south and Indian markets start participating in the global downtrend, you would see FIIs taking money out again. And in the worst of times, it is not necessary that FIIs would invest in any equity market, because what happens is, guys, that there is more demand for fixed income in the bad of times, in the bad times, than there is demand for risk assets. So the whole equity pool, it sort of shrinks in the bad times, and there are redemptions in equities and the money goes into other asset classes. It's probably going to happen this time as well. It's going to happen over the next 3 years. FIIs are going to be net sellers in equity all over the world, and including India as well. Thank you.
Thank you, sir. So with that, we have come to the end of the session. So before I could close, I would like to thank you, sir, for the insightful session that you have given, and also the participants who patiently, asking questions and waited for all this while. And the question which wasn't taken on air would be answered off air, and I would send it to you. So thank you for taking a minute, sir, to answer all those questions.
Thank you so much, Akshara. Thank you, everybody, for your time and attention. We are really, really grateful.